titled Rethinking Quant, Intuitive Signals and Unexpected Opportunities. Before we invite the speaker, I would like to invite the moderator for the event, Shreenivas Kunte. He's the director at the CFA Society India. In his professional work, he leads the content and automation aspects at HDFC AMC. He has been a director of professional learning and advocacy for the CFA Institute. Previously, he has worked with Citibank in Japan, and he is IT engineer from IIT Bombay. Shreenivas, over to you.
Thank you very much, Kunal. Thank you very much all for, it's a privilege and pleasure always to be with volunteers, and especially this conference, which is the India Investment Conference, a flagship conference. I was trying to get out and get people in, so not to extend my introduction of what we are going to do in this session. But if you look at the tagline for this session, take one more look at the tagline. The title for the session is Rethinking Quant, Intuitive Signals and Unexpected Opportunities. So there'll be lots of good opportunities in this session. I would like you to put your hats on of who you are. If you are a fundamental investor, put that hat on. If you are a macro investor, put that hat on. And then question what is going to happen within the quant world. We will have a friendly jugalbandi in the session, I hope, with what is quants and how others are thinking about quants. Now, we have been really lucky to have a very good speaker to take us through this session. Olivia Engel, she is the senior MD and head of strategy and investment operations at State Street. Olivia has got over 2 decades of very distinguished experience across different countries, different continents really. And she's looked at products, she's looked at processes, she's looked at research. She's also led a team of active quantitative equity for Asia for State Street. Give her a big hand. Olivia is, she has got a Bachelor of Commerce and Economics from the National University of Australia, and she is also CFA charter holder, and Olivia was the past president of CFA Society India. So looking forward to this session very much. I hope you enjoy it. Like I said, put your questions on. Think about this as a jugalbandi between quants and the fundamental world, between quants and macro world. And for me also, it'll be a good check to see if your questions are coming in this screen or not. So start thinking about the questions and let's enjoy the session. Thank you.
Hi everyone. I am absolutely thrilled to be presenting in front of a CFA audience. My connections with the CFA Institute and the CFA Societies goes back a long time. I received my CFA charter back in the year 2000, just as the tech.com bubble was bursting, and that was one of the pivotal early moments in my career. But you know, in terms of my career growth, in terms of my network, my professional network, the CFA Society is really very important to me. So I'm just absolutely thrilled to be here, and thank you for having me. Before I get started on my formal remarks, just in case you don't know State Street Global Advisors, we are one of the world's largest asset managers, and we have a very large investment team, including one here in India of more than 100 investment professionals in Bangalore. That is a part of our global investment team of more than 600 investment professionals. And we operate in all of the major asset classes. Today, I'm going to focus mostly on equities, but there's plenty more that we do. And before I do that, and I'm going to make sure that you're all awake and paying attention, I understand there's a lot of wealth advisors in this room. Can you please put up your hand if you are in the wealth advice segment? Okay, yes, see a lot of hands there. What about portfolio managers and analysts? Hands up? Okay, quite a few of you, great, thank you. And what about, if your focus is primarily equities, please raise your hand. Oh yeah, okay. I know my audience now, thank you. And is anyone in the room more focused on fixed income? Okay, yep, some names, that's good. I've got a little bit here about fixed income. And what about multi-asset class solutions or multi-asset class funds? Okay, good. All right, I've got some content here for you as well. That's great, okay. And coming back to the group of equity people, or even anybody, hands up if you have a reasonable level of experience with quantitative investing. Hands up. Okay, that's good. Okay, well that really helps me. Thank you for your participation. I think that helps me to make sure that I'm focusing on the right areas. So what I'm going to cover today, really I'm going to spend most of my time on equities. I think I'm going to be maybe challenging a few myths you may have heard about what quant is. I think there's a little bit about definitions that you may have assumptions about what quant is or what quant isn't when it comes to equities, and also, you know, where it used to be and where it is today. I'm going to very briefly touch on some new areas where quantitative investing is applied. Well, actually, in the asset allocation segment, it's not new, but I can touch on where quantitative approaches are being applied in fixed income and also in multi-asset. Okay, so quantitative investing, you know, what's the definition that we apply? Sorry, I'm just creating a bit of space here for my notes. What does quant investing mean? I mean, it can mean varying different levels of frequency in trading. Like, how long is the holding period in a quant strategy? It could be minutes. It actually could be seconds. It could be months. It could be years. So what you know of quant investing, you may put it in a certain bucket in terms of what the holding period is like. And if the holding period is short, the drivers of returns are going to be very different to if the holding period is longer. You start with the shorter the holding period, the drivers of returns are going to be very market microstructure oriented, very sentiment oriented, and the longer your holding period becomes, the more fundamental driven your returns are going to be. Is the investment process data-led or resourced using data? So when I say that, is how is research done in the quant space? Is it purely a statistical exercise, or is it something that starts with an intuition that then gets backed up by quantitative data? Rules-based. I think people often say quant investing is rules-based. So what does that mean exactly? What are the rules? What are the rules? Another question you may have, is it really active? Is quant investing active management? Hands up if you think quantitative investing is active management. Oh, good. Well then, you agree with me. Is there anyone in the room that thinks maybe quant investing is passive or just a rule no one needs to make an active decision about? Maybe some, yeah. Maybe some people do believe that. Okay. So I grew up in equities. That's where I kind of learnt to be an investor. That's where I got my personal investment philosophy. You may be wondering, how on earth does a quant manager have an investment philosophy? But yes, I do. But let me take you back to history. Where did quantitative investing really start? Well, it started with Markowitz and Sharpe, CAPM, modern portfolio theory, back in the 40s, 50s, 60s. So quant investing really had its start through that academic research. And then CAPM was built upon by Farmer and French, building upon CAPM with looking at additional risk factors in the market like size, value, profitability, momentum. These Farmer-French factors, I think, are very well known. They're very well known for CFA charter holders who study these in their exams. These were very simple, these we calculated using very simple data, very simple rules, applied very broadly when the research was done on US equity markets. So that was decades ago, and that's really where it started. But over time, there's really been a refinement of, and a nuance and a complexity get introduced relative to these traditional signals. But I think what sticks with me through time, what sticks with my philosophy around quantitative investing is that conceptually, it's about things we can all relate to. It's about coming up with concepts to measure valuation. Everybody in this room probably cares about the price they pay for a security when they buy it. It's about quality. How do you measure quality? Either subjectively or objectively. How do you measure momentum or sentiment? So yeah, value is about the price you pay for a company. Valuation ratios help you come up with that. Quality is about whether companies that are cheap for a reason, or cheap because they're really undervalued by the market. And then momentum and sentiment are really ways of helping us work out when is the right time to buy a company we found that is undervalued. Now, I'm going to go on a little bit of a sidebar for a moment because, and thankfully, the prior speaker, Rahul, I think said something during his presentation that really made me smile, actually, because he talked about emotion in investing. And I think one of the myths about quant investing is that it is completely unemotional. And I started my career in the year 2000. Sorry, I started my career back in the 90s, but I was early in my career in the year 2000. I was mid-career in the financial crisis, and I've recently gone through quite a challenging time for value investors. And I can tell you, all of those times were extremely emotional. And I'll tell you why, even as a quantitative investor. Because a quantitative investment process still needs to have subjective decisions made. How important is valuation when you're coming up with a forecast of expected returns? How heavily do you want to rely on short-term sentiment when you are forecasting returns? And what this chart here shows you is it's a very simple quintile spread return path of a group of value signals and a group of momentum or sentiment signals. And back in 2009, when after the global financial crisis and all of the deep value stocks reversed extremely fast, momentum signals had the biggest drawdown they've ever had. And so, and then on the way down during the financial crisis, every value stock that was getting cheaper and cheaper and cheaper every day, I remember in our investment team saying, I think we need to have more quality signals in our strategy. And the urge to do those things right at the worst possible time is real for any investor, quant or fundamental. So I just wanted to add in that little sidebar before I continue. It is definitely emotional. This is where I'm going to spend most of my time today. In our active quantitative equity process, we are forecasting stock returns for around 17,000 companies every single day from developed markets and emerging markets, large cap and small cap. And the way we do that is we've got dozens of different signals, more than 80 different signals, that we combine together to come up with a forecast that is approximately 12 to 18 months forward. So what that means is, and they're long-only portfolios, and for a broad market universe like developed market large cap or ACWI large cap, we would generally hold between 400 to 600 companies in those portfolios. So it's very diversified signals across those three main categories that I talked about. Valuation matters, quality matters, market sentiment and catalysts for return also matter a lot. Diversified signals. Some of these signals are quite close to some of the traditional signals that you may have seen in pharma and French. Some of them are just a small evolution on those signals. They're still relevant today. 6-month price momentum, because of behavioural economics, works. Sometimes it really does not work. It has big drawdowns like a carry trade, but over the long term, combined with other signals, and even the simplest measures work. But they're not for the faint-hearted because they can really, they have a big high tail risk on them. So here I'm going to talk about some of the nuanced signals where we've come through in the last 5, 7, 10 years and some of the drivers of that. So I'm going to start with a really simple one. Enterprise value to EBITDA. So this market ratio alongside price to equities, price to book, it's very helpful for evaluating across a very broad universe of stocks, being able to rank on relative valuation that neutralizes for different levels of debt. It's very useful in evaluating companies across the capital spectrum. It's an evolution from price to book, price to earnings. It's not complicated. It can be applied across all sectors of the market. So it's one of the broad signals that we can use. It's just the same as if a fundamental analyst needs to screen their universe before they then go and do their deep dive analysis. They may use ratios such as EV to EBITDA, they may use price to book, may use price to earnings, and then do more work. So the way we do more work after we've done simple ratios is with all the other signals that are incorporated. So it's just a simple one. This one, drug pipeline. This is one of my favorites, and we developed this signal when I was the Chief Investment Officer of our global team. And as a quant investor, the problem with evaluating biotech companies is that there's very little data that can help you evaluate them. It was one segment of the market we never could take positions in because there are very often no fundamentals in a biotech stock. There's a promise and a dream and a group of really smart research people that may or may not strike gold, so to speak, and actually discover a drug that cures a major disease. So we used to really say, we're not taking any bets in biotech. We just can't do it as a quant. And that's fine. You play where you can win. We wouldn't play there. But then we discovered a data set that helped us look at the drug pipeline, and we were able to source for a couple of hundred companies, pharmaceutical and biotech companies, to count, and intuitively speaking, like what is going to drive future earnings of a biotech stock, aside from whether their research thing works. Well, intuitively, if you have a company here that has, say, 10 or dozens of different drugs in later stages of clinical trial versus this company over here that has one single drug in an early stage of clinical trial, then, all else equal, I would say there's a higher probability that this company here will probably find something that generates future cash flow. So I'm not saying we've nailed the whole biotech sector by having a model that works perfectly and has the perfect hit rate, but this signal has definitely helped us to distinguish the higher quality versus the lower quality biotechs. And I know everyone in the room will have a lot more experience than me on the nuance associated with individual, research projects in the biotech sector. But this is just one reason where a small amount of data and a little bit of evolution just enabled us to increase the hit rate and do better in a sector. I'm not sure whether to talk about this one at all because in the midst of talking about emerging markets and tech and all innovation and everything, like who actually really wants to talk about banks? Anyone? Hands up if you are a banking analyst. All of this, oh, there's a couple. Okay, well, just for you, we have, I guess the theme here is that we've been able to develop sector-specific signals that only relate to companies in their either individual data that we can find for them, or the unique way that a fundamental analyst might approach valuing different companies. So we've got sector-specific signals in valuation, across multiple sectors. So in the banks, State Street Global Advisors has multiple equity teams. We have a systematic equity team. We have fundamental teams, both growth and value-oriented. So we have fundamental analysts we collaborate with. And the signal we came up with to sit alongside our other valuation metrics for banks was developed in conjunction with that team, whereby we recognize that, in talking to them, the minimum levels of capital that banks are required to hold, deviations from those levels reflect the strength of their operations and management practices. And so we looked at what filings are given to the Federal Reserve. It's a unique data set that only applies to banks and their capital requirements that is submitted to the Federal Reserve. Allowed us to come up with a theoretical price to book versus an observed price to book to assess the mispricing of a bank. So that was a collaboration effort. It was grounded in a very fundamental way of thinking, but applied in a way that allowed us to be objective across all banks in a consistent way without having to do individual analysis on the companies. Another collaboration effort with our fundamental equity team members was to actually directly use the framework and the experience they have. So they have a very disciplined process they've been applying over multiple decades with scorecards they come up with for every single company they research in order to judge the nature of the quality of that company and its ability to sustain growth over the long term. And so they have these are companies that they have a high conviction on for sustainable growth. So we use these detailed scorecards and the history that they had over multiple decades as a signal directly for the companies that they've researched. It doesn't apply to our whole 17,000 universe companies, but it can be used as an enhancer to our forecasts for companies that they do cover. Additionally, we've been talking to them about introducing a proxy signal for them to enable them to screen their universe better in a way that more reflects their investment philosophy, instead of using simple measures like, valuation measures or growth measures or whatever would be more straightforward to calculate. And because they've got the Quant team and more data, we can help them with that. And the last category of signals that I want to talk about is in the natural language processing space. So where this can apply and the way that you can, I hope, relate to what these signals are aiming to do. So when you dial into an earnings call and listen to the talking points from the CEO and the CFO, and then you listen to the Q&A or participate in the Q&A with the analysts and the participants on the call, what are you listening out for? You're listening out for confidence, you're listening out for uncertainty, you're listening out for something that wasn't in the financial reports and the financial statements that you can act upon, that you can say, oh, wait, there's something else going on here. So you're using, your experience and your listening skills to really see if you can hear something that somebody else didn't and take advantage of it. Because if the market's going to react to an earnings call, they're going to act quickly. So this is it's a sentiment idea. That's what fundamental analysts are looking out for. So what our natural language processing signals do is try and replicate that thinking. So originally when we started using these signals, we were really only focused on English language conference call transcripts, and we would count words. We would count words that were positive and words that were negative. That was the simple way to do it. I mean, it still involved a lot of data, but it was pretty simple. And today, we've really evolved some of those signals to be completely context aware. So using more advanced machine learning techniques, and you can actually understand the algorithm can understand the context of all of the words in the document and really come up with a score of whether the whole call was positive or negative. And these signals are working. We've been able to use these for a number of years now. And this is exciting stuff. This is where all of the, I think the analysts in our team have a really good time in their jobs. And there's some really fancy stuff they have to do, to, amazing skills that they're deploying here to write the code and do the analysis. And so, if you're interested, you can talk to Satish and Lakesh, who are here today, about coming to work for SSGA. Put the plug in. So there's a set of example signals, I think, of how quantitative investing in equities has really been evolving since new data has been available. So I'm just going to briefly touch a bit on a couple of other little snippets of information that might be interesting to you. So firstly, when it comes to, okay, you've got your signals, we've got our dozens of signals, more than 80 of them. How do you combine them into one forecast or one portfolio? And there's lots of considerations that need to go into that. So how do you weight the importance of every signal? How do you decide whether a signal applies to certain companies, countries, sectors? How long should you keep a signal for? When should you put new signals into your portfolio? When should you take signals out of the portfolio? So these are all complex things that need to be incorporated into the research process when we're deciding how to construct a model of forecasting returns and what signals to include. And there's lots of different methods. None of them are right. None of them are wrong. But this is the subjective nature, just like being a fundamental analyst, having your favorite stocks. Sometimes you'll be right, sometimes you'll be wrong. There's no guarantees. And then everything I talked about already relates to bottom-up stock picking. So individual signals that are calculated for individual companies and then aggregated. But you can also use quantitative methods to do top-down allocations. So in aggregate, which countries in the equity market are going to be the strongest? Which sectors are going to be the strongest? And in a time-varying nature, is now a good time for value or not? This is where emotion can really kind of come into it too, because, I mean, I am a value investor at heart. I have to admit it. So it means that, I never think I'm wrong. I always think I'm early. And so I have to check that at the door and many of my quant investment staff members were, very growth thinking, very optimistic. And here I was, the curmudgeon value investor, I was like, nah, it's too expensive. This exists in a quant philosophy as well. But having building an objective way, using research that demonstrates to you if value or momentum can work at different times, depending on the macro environment, depending on aggregate valuations, depending on aggregate risk aversion in the marketplace, then that's worth exploring from a research context. But our belief has always been that the bottom-up stock selection provides the most opportunity for value, for alpha, and the top-down is not as reliable as the bottom-up. And then I can't do a quant presentation without talking about the need for good technology and the investment in in data, the investment in processing power. Thankfully, we have the cloud today, so we don't have to worry about the on-prem servers that we used to have. We used to go and visit these servers in our data center, and it was all very fun, and there'd be like all these lights and things that would go bing, and we'd be like, wow, look at the database. We can't look at it anymore, but that's good because it means we can process the data we can process, a back test over 30 years that would have taken hours upon hours to run before. We can do it in seconds. Our forecast of stock returns contains about 150,000 lines of code. It's all distributed in the cloud. And we don't even use tick data for our quant process because we're only forecasting over a 12 to 18 month period. But still we have terabytes of data here. Okay, so now I'm going to take another little sidebar, which is to talk about emerging market equity for a little bit, because I think there's a little bit of myth busting I could do here as well, which is, emerging markets doesn't have good data. I think that's a good myth that I've heard as a quantitative investor that has done emerging markets. And also that, if you don't know anything about the geopolitics or, the threat of currency crises in emerging markets, then you're just going to blow up. You can't possibly be successful. So I think they're the two myths, and I think they're myths, and I'm busting them, and I'll tell you why. So, first of all, a good philosophy to win in emerging markets is to recognize that if you can just not lose, you can win. So if you can avoid these big tail risk events that happen more often in emerging markets than anywhere else, then you can win by just avoiding them. And so, emerging market returns, equity returns in general, and emerging markets even more so, have fat-tailed returns. So we can win by avoiding these blow-ups. Also, a concentrated portfolio has a much higher risk of being exposed to these tail risk events. So we think a diversified portfolio, and this is where I love to get into a debate with fundamental investors about only concentrated portfolios are good versus you can actually have hundreds of stocks and still produce differentiated returns relative to benchmarks. So our assertion is that a diversified risk-controlled portfolio is much better at avoiding those big tail risk events. And then if I back that up with a little bit of evidence, this chart you're looking at here, you're looking at not just emerging markets. We're going to go down a little bit more niche than that. We're looking at emerging markets small cap. Every dot on this page represents a manager in the emerging market small cap universe who has a 10-year track record, that has 10-year results. And on the x-axis, you have the active risk realized, so otherwise known as tracking error or standard deviation of relative returns. And on the y-axis, you have the active return. And so what you should expect, theory says the more risk you take, and all of our clients want us to take more risk so we can get more return. All the consultants want us to take more risk so we can get more return. But the evidence is telling me that it's very difficult to be compensated for that risk in emerging markets. That line should be upward sloping, if that's true. So you can actually achieve very strong returns with lower active risk, more risk-controlled portfolios, and it's very difficult to realize the active returns consistently. All of those major geopolitical risk blow-ups that are out there, maybe you get 9 out of 10 right, but the one that you get wrong, that tail event can really hurt a track record quite severely. The other thing about EM equity is that just like in developed market equities, smart beta factors are not enough. I don't think I said this earlier on. When I'm talking about the pharma French, very vanilla value, quality, sentiment, size, momentum, signals. I call that smart beta. So it's, continue to use those. I call that smart beta. Smart beta factors are not enough in any market, no matter how inefficient it is. Certainly not good enough in US equities, where mutual funds typically don't outperform at all on average, even in the EM space. So continuous evolution is still really important in emerging markets. Our signals, we've been able to develop our signals over a very long period of time using the whole market to learn from. So we don't need to specialize in emerging markets. We can apply, because intuitive investment rationale applies consistently across all markets. So yeah, the chart on this page really just shows you the risk-adjusted returns through time of new signals versus old signals. And then also one of the myths to bust is how much data is available. So there's plenty. I guess the bottom line is there's plenty of data. Even in the EM small cap space, we're covering 90% of our universe with at least one of our signals, at least 70% with many of our signals. And we've seen an explosion in the amount of data that's available. I also wanted to say the opportunity for added value just in the Indian market is very high. In both our large cap and small cap emerging market strategies, we find a large amount of alpha that is delivered, sourced from the Indian investment market. Okay, so 2 more minutes. There were a couple of fixed income people. Did you know that now there is an opportunity to do quant in fixed income? And traditionally, the reason why it hasn't been possible is because data has been a problem. Data in terms of, problems in terms of security mapping of data, problems in terms of transparent trading volumes, and availability of data history in terms of fundamentals. So we've been able to partner with an industry pioneer that has developed signals over a very long time, built a good database, coupled with the fact that the market now trades in a much more transparent way, to design a process that's neutral on risk dimensions like duration, sector and curve, and really focuses on active opportunities and applying the risk budget on a selection of different corporates, so applied in the credit space. We use some equity signals here to help with the selection of corporates in the fixed income space. And then also, briefly, asset allocation. You can use quant in asset allocation as well. When I say tactical asset allocation, what I mean there is multi-asset portfolios with tactical changes in their weightings on about a monthly basis. So forecasting 1 month forward of broad asset class exposures. We can start with a quantitative process to forecast these returns, but then we couple it with a qualitative process, and I'll tell you why in a minute. So the way we come up with quantitative signals in asset allocation is to start with broad asset allocation selection, so equities versus bonds versus cash, etc. And then use 2 ways of forecasting those asset classes. One, reflecting the sentiment in the marketplace of risk appetite, and one on the fundamentals, just like I was talking with equities, aggregate valuations, earnings forecasts, quality, momentum, those types of signals can be used in the aggregate at the asset class level. And then we also have within equities and within fixed income sector rotation models. But unlike equity and fixed income, where there are thousands of securities where you can play the high breadth game and exploit your hit rate, asset allocation doesn't give you that breadth. So, you've really only got a couple of dozen bets you can make in asset allocation. It's much more important to get a much higher hit rate. And so that's where a qualitative process comes in. So we start with the quant, and then we go much deeper with advice from our macroeconomists, discussions about politics and policy in global markets, and then having a very formal challenge and debate process to criticise every single position that is taken on a monthly basis. So that's how it works in tactical asset allocation. And a lot of it is driven by a proprietary market regime indicator which measures the aggregate risk appetite and helps us in timing of when to take risk and when to take risk off the table. I told you that bit would be quick. So I hope today, maybe I've challenged a few ways of thinking about quantitative investing, and I would love to take questions and have a chat with Shreenivas a little bit further, so thank you.
It was a brilliant presentation. My colleague there, Mr. Vijay, he said, he's on the board, he said that it was a brilliant presentation.
Okay.
We went through several aspects, right? We went through equities, fixed income, and asset allocation as well. We looked at the main thing that we discussed, fundamental investing, and how does it have its connects with Quants. So thank you again. So I wanted to, cover these 2-3 dimensions. One is fundamental, the other is macro, and also take questions from the audience.
Sure.
So we could, there's just 6 minutes left. So we could try to cover as much ground as possible. There are about 5 questions. But before I go there, right, what I missed in the introduction is that Olivia is distinguished not just for her work in quants, but because of her background, she was also a fundamental investor. So how have things changed from fundamental investing, and you've looked at products also, you looked at processes also, you have done research also, and you are a quant, or you were a quant. So how have things changed, and what are the main pressures in all of these areas? What do you like the most? I guess 2-3 questions there.
Sure. Yeah. So I did start my career as a fundamental analyst, and I think I would point to that experience as more helping me discover what I was good at, helping me discover where my beliefs really settled. And what I noticed, I wouldn't say I was a fundamental analyst for long enough to be able to claim that I'm a super experienced one, but one of the things that I found very challenging, and I think the best active fundamental managers do this extremely well, is when it came to conviction around stocks. I observed this debate, which I found very difficult to distinguish confidence, false confidence, I guess, from real skill. When I say false confidence, I mean the loudest, most confident voices in the room kind of won the debate. And I kind of questioned whether that was really the best way to come up with a portfolio. And I guess the truth is always in the results, but the dynamics in the room of weighing up personalities and how strong everybody's conviction was in arguing whether the stock would be a good add to the portfolio or not, I think just the human nature of that I found very challenging. And when I was introduced to a way of investing that, okay, this is how I feel about the stock, this is how confident I am in the stock, but the numbers, I'm just going to show you the numbers, and these are the numbers in this point in time, so the loudest voice doesn't need to make a statement there. So I think that's kind of how I found my place. Like, I found that I could have a lot of respect for the numbers, and fundamental investing is a hard business. I mean, hats off to all of you. Hats off to all of you.
You find refuge in data. So
I do.
Yeah.
I love a good spreadsheet. I really do.
Right.
Yeah.
So let's look it from a lens of one of the most famous fundamental investors, Munger. So he says that making big money is not just buying and selling; it's in waiting.
Yeah.
So, and you mentioned that as a value investor, a value investor feels that he's delayed or she's delayed.
That's right.
So
the market's wrong. The market is wrong when you're a value investor. I'm always right. Value investors celebrate the day they find the undervalued company. They don't celebrate when it goes up in price, they celebrate, like, I found it. I found the company that's undervalued. This is the one.
Right. So I mean, I still wanted to reconcile one more thing. I mean, the multi-baggers. Does Quant pick multi-baggers or not?
It's very hard. I say...
So maybe people are not going to take up Quants now.
I'll tell you in what context it's very hard. And I think I alluded to this when I was talking about biotech stocks. I mean, biotech stocks are either multi-baggers or they're nothing.
Bust, yeah.
There's no in-between with the biotech. And I think, if you are a momentum trader, you can find multi-baggers in Quant. You can find multi-baggers in momentum trading. But you're very unlikely to find multi-baggers using, I think, valuation and, finding lottery stocks, basically, yeah.
So I want to go back to Mr. Munger again, and for his Mungerisms. So he says that anything with a formula, he doesn't really believe in it. Now, how do you contrast that?
I guess that becomes a debate. So if he doesn't believe in a formula, does that mean he's never looked at a financial statement that has numbers in it? He's never subtracted, he's never divided the price by the earnings? That's a formula. Yeah,
that's true. That's true. I mean, he's saying in a way that, what you get really rewarded, if I understood him right, you get rewarded for mispricings. So to your point that maybe he has looked at what the right pricing is. Yeah. But let me move on quickly and I'll go to Mr. Prakash. I've been asking people, can you please supply questions? And we have got lots of them. It's a good problem to have. Yeah. So Prakash Shirke is a dear friend. He's saying, you looked at markets, over 2 decades plus, right? And, markets have matured, they've changed. Maybe emerging markets have also matured. Some of them have emerged already. So Prakash's question really is, as these markets mature, do the quant strategies change or are they simply the same?
I'd say there are things that change and there are things that stay the same. And the things that stay the same are that we're all humans and we all have emotions and we all have bias, behavioural biases, and the things that drive us to make decisions, any investor to make decisions. That is a constant. And so that is why things like momentum investing will probably always work until those moments in time when they don't, and then people get scared. And so there's a risk appetite, a risk premium associated with that. In terms of how things do need to evolve, new data, new trends in industry, for example, the prevalence of intangible assets, incorporating intangible assets into the way we evaluate companies across the market is a thing that has really evolved in the last 20, 30 years. So that's something that had changed, that we needed to evolve in the way that we assessed valuation for companies, for example. How do you incorporate intangible assets? So that's just a couple of examples. And that applies whether it's emerging markets or developed market equities.
Right. Namit Arora, he's a quant investor as well, if I understood him right. He's asking, do you think a strategy should focus on a single factor like growth, value, low vol, or do you recommend a multi-factor strategy?
I would definitely always say multi-factor, but I know there are people who have high conviction on that one signal that they've invented that they want to invest in personally, but when it comes to building robust, diversified processes that have good risk control, I would always say multi-factor.
Right. I'm moving quickly on without reflecting much. Thank you so much. So Sharon is asking, on your thoughts on using trends in multi-asset strategies. Is it more applicable for tactical or strategic asset allocation?
Well, strategic asset allocation also is derived based on long-term asset class forecasts and long-term assessments of volatility, and there's lots of nuance that goes into that. One of our researchers at State Street has written a paper about how to evaluate private assets that don't trade very often relative to listed markets. And so, that is a very quantitative idea. He's developed it, and that relates to strategic asset allocation. But both, really, you can apply quantitative methods.
Right. I just had one question that stuck with me. You showed one nice graph about emerging markets, active risk, right? And the graph was sloping down, which means there's no point in taking active risk. Is that right? So
well, it's very difficult to take active risk consistently and generate returns that are commensurate with that level of active risk.
So does that apply to developed markets as well and the world in general?
I would say that yes, to some degree there is,
Right.
I think it's very stark in that environment, but in general you would see kind of a flat line. Like in many markets, active risk is not paying off over long periods of time.
So is that a learning for all of us? Maybe we need to debate it with folks at CFA Institute as well. But let me go to the next question.
I think there are many forces at play that make it difficult for active managers to take the bets they want to take.
Right.
And have high conviction in a position that isn't working for them for multiple years and stay with that bet.
Yeah.
So, I mean, look, the reason why active managers can underperform, has some structural industry kind of governance dynamics associated with it, particularly in the institutional world.
You are in good company, Olivia, because Daniel Kahneman has said it and a couple of Nobel laureates as well.
Yeah.
So your views on quantum mental strategies from Palak?
Yeah. Well, I think what I talked about today is kind of like quantum mental.
Yeah.
I mean, you start with a fundamental idea. You're like, how do I use data to exploit that? That's quantum mental. That can be.
So let's go to machine learning and AI. Vaibhav is asking, most of the machine learning models would give similar output. I don't know why Vaibhav is saying that, but then reaction would be fast. I'm just reading out the question. How to resist a reaction at the inappropriate time?
From an AI model. How to resist a reaction at the inappropriate time. I guess in our experience, we don't rely on an AI model to make all the decisions. And there are many different things that we fully understand and we can understand why Apple is liked or not liked by a model. Like it's either because it's cheap or expensive, it's high quality or low quality, it's got strong sentiment measures. Okay, these things, we can all interpret it. If we would have an AI model that forecast the stock return without really us having any idea what went into that, then I wouldn't be comfortable with that at all. We need to be able to relate to why is this. We need to be able to intuitively say that makes sense when companies are ranking high or ranking low in any model. So an AI model, if it was all self-contained AI, would make that very difficult.
So what's a day like in a quant analyst or quant fund manager's life? Do they have to do nothing once the model is set?
Our analysts and portfolio managers, particularly the lead portfolio managers, who are really responsible for portfolio design, what are they thinking about? They're thinking about whether the signals that are in the strategy are performing as they should. So there's a lot of time spent on performance analytics, performance attribution. Is the return in the portfolio coming from the signals we expect? And quantitative factor-based attribution is hard. Like, it's not easy. There is no right way of doing it, and there's always a big residual that, the unexplained. So, we've got a whole team of people that have spent a lot of time talking about attribution. And attribution is a really important tool in understanding and making sure you're getting the right exposures in the portfolio. So we spend a lot of time on that. We spend a lot of time thinking and talking to the street and our fundamental analysts about themes and the ways they invest and coming up with signals to replicate that. I mean, there's a lot to be done. I've only scratched the surface, and I know that this red screen that's saying time is up.
So I've got just 2 questions now, Kunal. Just help me with them. So one is from Gitu, right? She's very worried about the churn ratio. And
about what ratio?
The churn ratio.
Or churn.
So you mentioned 100 stocks in your portfolio, right? 50, 100 stocks?
I don't think I mentioned. Actually, I did. I said between 400 and 600 companies in our broad market index portfolios.
So is that a lot of churning? Is it tax efficient in the US or other markets?
Turnover is relatively low for these low tracking error.
Okay.
So we have, depending on the tracking error, sort of determines the amount of turnover in the portfolio. So our portfolios have between sort of 30% to 60 to 80% turnover per annum. So, a lot of stocks are not even turning over once a year.
Right. Okay, the last question of the day from me is, good resources for people to look at, if they want to learn more about quants. If they wanted to set their own shop, a lot of them are wealth advisors at home. Where should they start?
Yeah.
How should they? Can they do this at all?
Yeah, I mean, I guess there's one aspect. There's how do you learn the data science skills if you really want to be a quant investor? Maybe how do you learn about what's been driving the industry? So obviously there's lots of courses you can take on how to be a good data analyst. You know, you need computer science skills. But on the investment side, maybe you can learn from some great investment professionals who have, you know, done great things in the world. So there's a lot of people out there that's written great books on their experience of it as an investment professional. I mean, there's, you know, Renaissance Capital, for example. The man, somebody in the people in the room have probably read The Man Who Solved the Market. Is that what it's called? Yeah.
Yes.
I mean, that's one way of quantitative investing. It's not the one I was talking about today, but there's many books out there. I would read some biographies on, you know, how these strategies came about to just sort of get more of a feel for the market more broadly.
And there's a lot of material on State Street website as well, right?
Yep.
You can download it?
You can always go to ssga.com, and we've got plenty of research insights. We've got some papers there on the spectrum of conceptual active management, which one of our head of research has written. We've got our global market outlooks, our long-term asset class forecasts. Everything there is on our website. Hopefully you can access it from India.
Thank you. Thank you very much, Olivia. It was a very nice session. Thank you so much for having me.
Thank you.
And special thanks to Satish and Lokesh as well from State Street. They have really made this happen time and again every year. Thank you very much.
Thank you.
Thank you, Olivia. Thanks, Shreenivas. I would like to invite Vishal Kapadia, Head of Sales, NSE Cogensis.